Good morning, good afternoon. My name is Liliana Rojas Suarez. I'm a senior fellow at the Center for Global Development. Welcome to the launching of the results from the CGD project, a decision tree for digital financial inclusion. A project that aims to identify what are the root causes of low usage of digital financial services in emerging markets and developing countries. You can find all the material from these projects in the link cgdep.org/decision tree. We all know that in recent years, many countries have implemented reforms and policies to improve digital financial inclusions, and with very good reasons, since the large benefits from inclusion to the poor are very well recognized by now. However, despite these efforts, results are at best mixed. While some countries are achieving impressive gains in inclusion, many others are significantly lagging behind with a low take-up of digital financial services. So, for policymakers that are in charge of designing these financial inclusion strategies, a critical question is how to diagnose the most important constraints that explains the digital financial inclusion gap. There are many constraints impeding inclusion in many countries, but which are the binding ones? The root cause of the problem. Answering this question would help authorities to prioritize their actions and focus on relaxing these binding constraints, as opposed to dealing with many possible constraints, some of which might not be binding, and so lifting them would not bring important gains in inclusion. This CGD project focuses precisely on this issue and had two parts. First, we developed a methodology that allows analysts and policymakers to identify country-specific binding constraints. In the second part, the methodology is applied to 5 countries around the world: Ethiopia, India, Indonesia, Mexico, and Pakistan. In the rest of the program today, we follow these same 2 parts. That's the way we're structuring our program today. First, I will briefly present the decision tree framework, and then I will engage in a conversation with the authors of the 5 case studies to learn about the results, the lesson they would derive from applying the methodology to the particular country setting. I will introduce them briefly, but first, let me quickly present some of the central points of the methodology. Those of you that are familiar with the work of Hausman and co-authors from Harvard University for diagnosing the root causes of economic growth will recognize the similarities of their methodology with ours. And indeed, this is the case because we built upon their work to construct a decision tree that is applied for digital financial inclusion. Since one picture is worth 1,000 words, let me show a summary version of the tree. For that, allow me a second to share my screen. So, consider a country where the provision of digital financial services excludes large segments of the population, and the goal is to identify the root causes of this problem. Well, the decision tree divides the causes in supply and demand constraints and follows a top-down approach. The tree starts by asking the broad potential causes of either the supply or the demand side. So the first level, the upper branches of the tree. In turn, each of these constraints can be explained by a number of additional factors. So that could be the lower branches of the tree. And so on, as the analysts dig deeper into the root causes of exclusion, more causes could actually be identified. This is not the time to get into a full explanation of all branches of the tree. But I need to say that its construction is based on the existing theoretical and empirical literature on potential causes of digital financial exclusion. Obviously, the causes, namely the branches, will depend on the service that we are analyzing. This particular tree that we're presenting here is for digital payment services. As you can imagine, a tree that applies for digital payment services will be different from one that is constructed for the provision of and the usage of credit services. So in this tree, in the digital payment services tree, potential barriers on the supply side include and can be divided into three areas. Constraints arising from the market structure of the providers, being them banks or other providers, digital service providers that are non-banks. Or another important cause of the exclusion problem is the insufficiency of digital infrastructure. And a third cause is low appropriability of returns, meaning problems encountered by providers in appropriating the returns from offering those financial services. On the demand side, the potential causes identified on the first level are customers' perception of very low benefits from using the services. So they are not demanding the services because they do not perceive the usage have important benefits. Or the customers do not trust providers. Or there are more structural issues, more difficult to deal with, like the populations with very low income or located in challenging geographical areas where distance to access point deter them from demanding the services. I'm not going to get into the explanation of the lower branches and the rest of the tree for the sake of time, but it is important to know and underline that the tree allows for country-specific adjustments. For example, the application of the methodology for India includes social norms as an additional obstacle affecting the usage of digital financial services by women. So having identified that these are the potential causes, the obvious next question is, how do you navigate the tree? How do you, among all these constraints, disregard those that are not relevant or are not that important, and which of them are binding? So to answer this question, what the methodology proposes is that the analyst needs to use a wide set of indicators that are built from hard data, perception surveys, and stakeholders interviews, which we found are extremely useful for getting to the root of the analysis. Most importantly, the indicators constructed by the analyst are used to test each potential constraint using a set of principles provided in the methodology. The methodology includes 4 principles that I'm not going to discuss here, but let me just briefly touch on one. Let me stop sharing. To get an additional indication as to whether the binding constraint is on the supply or on the demand side of the tree, a powerful signal is provided by prices, namely the fees charged for the usage of digital financial services. Just observing the quantities of usage, for example, the percentage of the population that use digital financial services, will not be enough to know whether the constraints, the binding constraints, are on the supply or the demand side. Why? Because low usage is consistent with either low supply or low demand for the service. However, if we look at fees, the low usage of digital financial services can be attributed to supply side constraints if the fees charged for using the service is high relative to either a similar service or the price charged in other countries at similar level of development. Of course, the prices should be properly adjusted for international comparisons. In this case, when the fees are very high, providers are only willing to supply the service at these very high prices, which will exclude large segments of the population. On the other hand, if the fees are relatively low, this likely is indicating that the binding constraints are on the demand side. And this is because customers are not either willing or capable to use the service, even if the charge fee is low. Well, collection of fees and other costs, direct and indirect costs of using the services, including the cost of commuting, the cost of using digital technology, collecting these costs is quite an important task for properly apply the decision tree methodology. For the sake of time, I'm not going to get into more details of the methodology. As I said, you can find all of the information in the project webpage, ctdep.org/decision tree. Instead, let me move now to the more interesting part of our program, a conversation with the authors of the case studies that apply their decision tree to their country settings. Once again, the 5 countries are Ethiopia, India, Indonesia, Mexico, and Pakistan. We selected these countries for 3 reasons. First, they have all of them low levels of digital financial inclusion compared to countries with the same or similar levels of development. Second, the authorities in all these countries have stated that improving digital financial inclusion is a high priority goal in their development agenda and are implementing serious initiatives. And third, all these countries are populous countries, where the improvement of digital financial inclusion could have significant impact on a large number of people. Just to give you an idea of the importance of these countries, using the metrics presented by the authors to measure digital financial inclusion, the excluded population from these 5 countries alone roughly amounts to 1 billion adults. Each case study was conducted by a team of researchers. All the case studies can be found on the project page. Our conversation today includes from Ethiopia, Tadel Ferede from Addis Ababa University. From India, Nandini Harishariwara from Contigo Global. From Indonesia, Herman Witoliar from Australia National University. From Mexico, Miguel Sekeli from the Center for Education and Social Studies. From Pakistan, Imran Khan, an independent researcher. Let's start. Nandini, in your analysis of costs paid by consumers to use digital payment services, you distinguish between different income groups. What did you learn from this exercise?
The cost of digital payments by our analysis is very affordable to some Indians. We estimated both fixed and variable costs to Indians to use digital financial services. Fixed costs are things like ownership of a mobile phone, opening a bank account, or accessing the prerequisites for an account, such as a national ID. Variable costs are the marginal costs associated with each transaction. Things like travel to and from an access point, transaction fees paid to the financial service provider, and data charges required for using internet-based services. Broadly speaking, access has a fixed cost, usage has a marginal cost. By our estimates, the average fixed cost, including a smartphone, that was an assumption we made, was about 84 US dollars, or about 6,100 Indian rupees. The average yearly variable cost was about 96 US dollars and about 7,000 Indian rupees. Now, when we estimated that cost as a representation of income, we looked at different kinds of income levels. It's important to note here that India's GDP per capita is approximately 2,120 US dollars. However, that's not really representative of a large percentage of the Indian population. So therefore, we kind of looked at what the fixed and variable costs of digital financial services would look like for different income groups. So one income group that we examined were maybe people in a lower or middle income range of about 922 US dollars a year. The second tier would be for a poor person, perhaps with an annual income of US dollars 720. And lastly, the ultra poor person that would have an annual income of $360 a year or less. Not surprisingly, based on this analysis, there is a regressive cost to the use of digital financial services. For ultra poor populations, if you combine the fixed and variable costs of digital financial services, it could be up to 50% of their income in that first year, and then a quarter of their income thereafter. To some, the cost of digital financial services could be prohibitive. Note, these calculations do not even account for the amount of time that it takes to access a bank account. This is especially important given the level of time poverty that low-income populations face, especially women. Devara Trust has done some excellent research on the experience of the poor in trying to open a bank account and the challenges that they face. They note that investigators dedicated a total of 7 hours on average to opening each account, and this is referenced in our paper.
Imran, an important feature of the methodology is the analysis of fees and commissions charged for the provision of digital financial services to identify whether the binding constraints are on the supply side or on the demand side. Can you please briefly explain what fees did you consider in your analysis of mobile money services, and what were the most important insights that you actually got from the analysis?
So we compared Pakistan with 7 other countries, and for each country we chose one of their most popular mobile money provider. And then for each we looked at the transaction cost for various denomination of financial services, whether it's transfers with the over the counter or through the wallet, or cash withdrawals, whether you do it at the mobile money agent or through an ATM. And what we found was that Pakistan consistently ranked among the countries, at the top 3 countries with the highest costs, transaction costs. And this sort of nudged us towards the belief that our binding constraint might be on the supply side. And although we did go through the demand side constraints and analyzed it all, but this gave us an earlier indication that the constraint might be on the supply side.
Thank you, Imran. Thurman, what fees did you consider in your analysis of mobile money market, mobile money services? And what were the most important insights that you got?
For most types of mobile money that are issued by non-bank providers, cash out services are not allowed. So the cost to withdraw money from these accounts would include the external transfer fee to a bank account and the withdrawal fee charged by the bank. So if you don't have a bank account, then you cannot cash out your funds from your e-wallet. And this should be taken into account when thinking about prices that consumers face when using mobile money. Overall, we see that the prices that consumers face is relatively high compared to other countries that we look at in our study. And this suggests that there's a constraint that is binding on the supply side. And so that's, I think, one of the key findings from our price analysis. And one important insight that we got from this approach is, this methodology, is that some of the most important prices or costs that may not be the ones that have directly observable price tags on them.
Tadele, in your paper, you highlight the importance of the decision tree as a benchmarking exercise and use certain criteria to select comparator countries. Why did you do this? And what was the criteria based on?
The use of benchmarking, as initially articulated in the Rogers, Soros, and Clausen's methodology, that benchmarking is extremely useful in terms of comparing countries, and also in terms of where a country stands relative to other countries. So we used a number of criteria to identify comparator countries. The first one is the comparator country should be a front runner in terms of the use of digital payment services and also digital financial services as well. That's the first one. The second one is on socioeconomic characteristics, and similar to those that of Ethiopia in terms of policy environment and geography. And another criteria is the data availability and data availability for the information that's required to conduct the analysis. So based on these criteria, we have identified quite a number of comparator countries, both in Africa and outside in Africa. Largely within Africa, we focused on 4 countries. The first one is Kenya, Tanzania, Rwanda, and Uganda. For Tanzania, for Kenya, we selected this country because Kenya is a front runner in terms of the expansion of digital payment services in the continent. Tanzania, it's similar to Ethiopia. Tanzania is facing a challenge of large rural population that's excluded from digital payment services. This is a case in Ethiopia too. So for Rwanda and Uganda, these are both landlocked countries like Ethiopia. Ethiopia is a landlocked country, so both Rwanda and Uganda can be very, very comparator country along this geographic and policy environment perspective. And also, we have also selected other countries outside Africa to see where Ethiopia stands in terms of the use of digital payment services for this study.
Thank you, Tadele. Firman, Indonesia has a somewhat particular system in which non-bank providers are quite varied and actually different from other countries. For instance, Gojek, which is the equivalent of Uber, offers what could be considered mobile money. What are the particularities of the digital payment services provision in Indonesia? And how have these particularities shaped your analysis?
So yeah, the development of digital financial services in Indonesia is certainly interesting. I mean, the type of mobile money that dominates the market is different from what we have seen in countries like Kenya, where the use of mobile money is fueled by person-to-person transaction through mobile phones. Well, in Indonesia, on one hand, you have state-owned banks issuing e-money and establishing agent networks to provide basic digital financial services. But on the other hand, you have these non-bank providers, which are mainly e-commerce firms that started to establish their own digital payment system or partner with digital payment companies. Indeed, in Indonesia, the growth of digital financial services is led by this e-commerce, and Gojek is definitely the best example of that. And I think by now, probably those who have been observing the digital financial landscape in Indonesia would be familiar with the Gojek story, right? Gojek started as a ride-hailing services that people use to navigate the notorious traffic jams in Jakarta and other urban cities in Indonesia. And people use their apps to get these rides. But then they started to set up their own payment system through that apps, and their services grew into other services, most prominently food deliveries, courier services, and so on. And in doing that, they connect their users, their expanding users, with also an expanding networks of merchants, small businesses, home industries. So these types of e-commerce, the Gojek, and there's also Tokopedia, Bukalapak, they expanded and did so, and so did their digital payment system. And despite the absence of regulatory framework that were fully set up to accommodate them. So, for example, there are different rules governing the services that non-bank providers can offer, and there are different rules governing the recruitment of agents that they can do, and so on. So to a large extent, we think that digital payment services in Indonesia are centered around e-commerce. But interestingly, banks are also quite responsive to this e-commerce, the development in the e-commerce system, and also fintech. So in some ways, this makes our analysis more interesting, but also a little bit difficult because you can't really easily compare between this different payment system, or even looking at different countries. And also with the pace of how things are going, both from the innovation side as well as from regulatory changes, it's really almost like shooting a moving target.
Thank you, Ferman. Miguel, your analysis shows that the current regulatory framework in Mexico is a binding constraint for the expansion of digital payment services. Can you briefly explain why? And what is your assessment about the Mexico's authorities' capabilities to remove that constraint in the short to medium term?
Yeah, actually, this is one of the most interesting parts of the paper, because Mexico, as you said at the beginning, has made very considerable efforts for simplifying the market and for trying to expand financial inclusion precisely by deregulating. And but we found that there are still important challenges here. One of them is that there are very strict regulations for authorizing the operation of corresponding agents. So actually what happens in practice is that only a big retail chain of stores has fulfilled these requirements. And they have discouraged smaller shops from also acting as corresponding agents, which reduces the cash in and cash out access points. This is at the heart of the problem of the prices, the high prices, the limited supply of corresponding agents. So in terms of regulation, one of the challenges is how to reduce the burden so that many more instances can become corresponding agents and still do it in a way that it gives certainty for the users. A second element in the regulation is that Mexico authorized a fintech law, very recent, 2019. It's a very new law. And actually, unfortunately, it coincided with the pandemic. The rollout of the law in terms of the authorization of new financial institutions to be able to operate as digital financial providers didn't really flourish, or hasn't really flourished yet as expected. But then using the principles of the methodology, which was very useful here, we found, and one of the principles is to analyze whether this is a constraint, the regulation is a constraint, if you find that different entities are trying to bypass the regulation. And that's exactly what we found. We found that many institutions, rather than becoming agents themselves, have associated with other kinds of institutions, a very low number, that have actually been authorized by the National Banking Commission. And rather than seeking this authorization, they bypass the regulation by making partnerships with institutions that are already there. So that was for us a very important piece of evidence that regulation was a problem. And it came out also with the interviews that we had with different relevant agents. And in terms of the last part of the question, Liliana, in terms of the capabilities to remove the constraints, what we think is that with the rollout of the FinTech law, now that apparently it will start moving faster, we hope that the authorities will be able to fine tune. If what we thought was a very good law in practice is not having the effects that we thought, this definitely leads us to go back to the design table and see what we need to modify in order to make the law a channel for expanding financial inclusion and not limiting it.
Nandini, you identify coordination failures as a binding constraint in India. This is perhaps one of the most complex branches of the decision tree. Could you explain your analysis on this topic and your results?
Coordination failures is particularly difficult because it involves aspects of both the demand and the supply branches of the decision tree. Digital payments, particularly merchant payments, but really digital payments writ large, have been characterized for a very long time as a chicken and egg dilemma. Neither side wants to be the first to adopt. For example, merchants won't invest in digital payments hardware if they don't think customers want to use digital payments, and customers won't make digital payments if there's no digital payments hardware. So understanding whether coordination failures are a binding constraint is really complex because such failures are a function of both supply and demand factors. So we can see that in certain parts of the Indian market, we're stuck at an equilibrium level below the market's potential. But how do you break down the constraint between what's happening with the merchants and what's happening with the customers? There's clearly issues around expectations, beliefs about the other group, and trust, but we didn't want to just identify constraints. We wanted to work out which were binding. There is good micro level evidence from a study in Jaipur that analyzed this exact question. They tested several hypotheses for why merchants might not adopt digital payments, including things like obtaining a bank account, an appropriate device, internet access, profits to cover usage fees, and technological literacy. And they found that none of those explained low adoption. Rather, they put it down to low perceived customer demand, indicating that in this tier 2 urban setting, the binding constraint would be on the demand side. However, we can unpack elements of the supply-demand relationship to help understand to what extent coordination is a constraint. We examined it in 2 ways. First, to see the relationship between merchant acceptance of digital payments and usage of digital payments by customers. And second, understanding the preference for cash. As I mentioned before, in the first, the evidence suggests that there are important coordination failures regarding the adoption of digital payments in urban settings. Merchants mostly accept only cash as they perceive that customers have a strong preference for cash. And customers are not interested in the usage of digital payments because of their experience with merchants not accepting them. Again, back to chicken and egg. This suggests strong evidence for coordination failures to be a potential binding constraint in urban settings. As for demand for cash, Indians are increasingly using it as a store of value and demanding cash transactions. So it does not yet seem that we're at a tipping point for India to become cash-free.
In Pakistan, we see a clear example of Principle 2 of the Decision Tree in operation. This principle states that if a constraint is binding, we will see that its removal or implementation will have a large impact on digital financial inclusion. In your analysis, you actually observed that a huge increase in the preference for cash, and therefore a decline in the usage of digital payment services when a withholding tax for individuals not filing tax returns was implemented. Could you tell us what happened at that time and the variables you analyzed to measure the impact of this tax?
What happened? I mean, this is a continuation of the policies, previous policies, but this time it was quite an extravagant tax was slapped on non-filers, where there was an additional sort of tax cut when they withdrew money from banks. And this had implications for people who were non-filers, which is the majority of the country, and were also banked. So what we saw was that the ratio that specific ratio that we used was the ratio of currency in circulation to deposits. And we saw that this ratio sort of increased right after the imposition of this tax, and it continued till 2020. So that was one thing that, I mean, we saw the application of the second principle in action in Pakistan.
Miguel, what could be your recommendations to other researchers or policymakers that could like to apply the decision tree methodology to their own countries?
What I learned from this, apart from the actual analysis of digital financial inclusion, was basically three things that I think could be useful for others. The first is that you have to be ready to get out of your comfort zone, because this is a new approach, and being a new approach, it forces you to use a way of thinking that is different to our conventional approach to this. In our case, we are used to a much more statistical approach using regression analysis, statistical methods, and here we use them also, but in a very different way. So be prepared to leave your comfort zone and to work hard. It's not the number of hours you spend, but if you're able to engage and to really understand what the spirit of the methodology is. That is the first advice I would give. Get ready to move from your comfort zone. The second advice I would give is that this methodology will force you to look at data sources that you haven't looked at. So it will, in the end, since you go to the supply and to the demand, even though you find in the price analysis that it points to one of the two, you will have to make the case in the end by doing the whole exercise. So be ready to move in terms of that. When you, for example, when you use statistical tools, perhaps you run a regression, you find that one variable is significant, and perhaps you stop there. Where here that will not be enough. You will have to look at the others. You will find that it's as important to find a significant variable than to find a non-significant variable, because you will only be able to prove that it's a binding constraint if you are able to discard the other elements. So be ready to complete the full circle. It's not only going one way, thinking you have solved the puzzle, because you will have to prove that it is a case by also going through the other path completely. And the third piece of advice that I would give is that it's very important to talk to people. And this is something that Liliana insisted upon. And at the beginning, since we were more familiar with a statistical approach where you don't talk to people, you simply use the numbers and try to make the numbers speak. Here, it's very important, because since you are looking for the binding constraint, the ultimate binding constraint, when you talk to people and they tell you how things operate in the real world, you find out that perhaps what you thought was a restriction is not really as such. There's something below. And that is very difficult to get only with data. You have to talk to people, and you will hear stories that will help you interpret what you're seeing. In Mexico, for example, one very insightful interview we had was with the only provider among banks of the only big provider of digital financial services. And he told us the story of how this started and why others didn't get in the market and why they did. And that was very, very useful. That actually enlightened us to look at things that we hadn't even considered. And these are things that are not apparent in the normal data that you see. You have to dig in more. And then you get to a point where you think there's no more information, and perhaps you have to go back to your informants, and perhaps there is more information that will allow you to confirm. So I would also definitely advise to not only think of this as an exercise that will be will have numbers to support whatever you find. It's very important to talk to relevant actors in the field and let them speak also. Let them show why, let them tell you what is the problem, and then you can go back to the computer and process data, but you will be able to direct your search in a much more productive way.
Nandini, what are your recommendations for the Indian authorities?
The government of India is active and is a leader in the digital financial inclusion space in the world. It's reflected in its national financial inclusion strategy, and many of the constraints that have been talked about today are already being tackled. There are numerous government efforts to increase the financial inclusion and economic empowerment of Indian citizens, especially those traditionally marginalized. Based on our analysis, we have 3 recommendations. First, consider moving away from a straight bank-led model. As the digital payments space has evolved, that debate on the bank model versus the MNO model has also evolved. In many markets, one is seeing that it's not the best company that necessarily succeeds, but the best partnership. Partnerships that are able to leverage the assets from both companies, for instance, a distribution network of a telco and credit decision-making banks and microfinance institutions, have been producing some of the most innovative, useful products for low-income customers worldwide. This should be considered as regulators, banks, and other determinants of the current system consider the future. Second, there should be an effort to provide a publicly available supply-side analysis of the market based on transactions. In writing this paper, we found that determining the spread of assets across financial institutions was straightforward, but determining the number of active customers and volume of transactions across financial institutions and products was quite challenging. If transaction-based business models are key to addressing digital financial services and digital financial inclusion, the availability of data on active usage is quite critical. Third, the Indian financial services ecosystem should strive to understand why Indian customers perceive low benefit from using digital financial services and have low trust in the providers. And they should work to design the marketing and structuring of financial products to better suit the needs and earn the trust of people who are financially excluded. Really interesting studies like the financial diaries of garment workers in Bangalore called 1,000 Cuts, Life as a Garment Worker in Bangalore, or the Omidyar Network and Dalberg Global Development Advisors Currency of Trust reports find very interestingly that poor Indians, even when paid into bank accounts, withdraw their full amount in cash and use informal financial services to manage their lives. Even the most financial savvy customer often prefers to use banks only for large transactions. Given that one of the biggest use cases for digital payments is a safe place to store funds, these reports illustrate the work that the Indian financial services ecosystem has to do to overcome this perceived benefit challenge. The government of India may want to consider what this last point means for the services it has mandated that have no doubt increased access to and usage of financial services, especially PMJDY accounts. However, perhaps even after opening these accounts, the country's very basic financial services, digital and non-digital, continue to not meet the needs of many Indians. What the government has put into policy on paper may not always be implemented at the local bank branch level, thereby leaving a gap between the intention of the government and the reality for the poor Indian citizen. This is a challenge for many markets.
Thanks a lot. To conclude, Tadel, I would like to ask you about your experience with using the methodology. Did you find it useful?
I learned a lot from using the decision tree methodology. It's a very powerful and robust framework in terms of assessing both the supply side and demand side constraints of digital payment services, or for that matter, any other financial sector challenges. So it's an action-oriented methodology. So that provides clear guidance in terms of what to intervene and what policy interventions should implement and so on. That's from a policy making angle. From a researcher's perspective, I think this is a very this methodology is extremely flexible. It can be applied to country circumstances, country contexts. If researchers wish to provide robust and evidence-based policy recommendations and evidence to policymakers, this is the right methodology to use and apply that help identify and prioritize actually the key and the root causes of certain problems.
Although we could continue this conversation for hours, this is all the time we have today. Thank you very much to the panelists and to all the other authors that for the sake of time have not been able to participate in the discussion. Thanks a lot to our audience. We at CGD hope that you find this project both intriguing and interesting. Once again, you can find all the material, including the paper describing in detail the methodology, the 5 case studies, blogs and videos at cgdept.org/decision tree. Goodbye.